Hi there, welcome to Economic Observations. My name is Chris. Today is Monday, January 10th. Well, the market had a sell-off today on fears that the Fed was going to raise interest rates on 4 occasions today after a report from Goldman Sachs came out this morning. Dow was down, NASDAQ was down, S&P was down, everything was down. So why was it down, and what is the future of the rising interest rates, the Fed taking a bazooka vacuum to their balance sheet and trying to reduce the balance sheet from $8.7 trillion in bonds and mortgage-backed securities and reducing it pretty much by half. Okay, and that needs to be done, and that's what the Fed is planning to do. So upon a word that this is happening, a lot of investors get spooked. They go from the growth stocks or the riskier investments and they invest in a more stable value company, right? It's all dependent on balance sheets and companies, and some companies can withstand the tide going out, and some only can sustain if the tide is going in and things are rosy. So a lot of investors start, pulling out of the tech industry and pulling out of the riskier investments, and they put it more in a more stable, interest-bearing kind of investment, right? And that's what was happening today upon spooks that not only is the Fed going to reduce its balance sheet, but interest rates are going to rise on 4 occasions this year. So that's what happened today. We hadn't seen this happen since 2013. There was an attempt to raise interest rates, and when the market fell, the Fed reversed course, and then it was just news. They didn't even do it, but upon news that the Fed was going to do it, the markets went down a little bit, and the Fed reversed it and never attempted to raise interest rates until 2018. But in 2018, we didn't have the inflation that we have today. So now we have to raise interest rates because inflation is at 7%, or so they say. I personally think it's a supply and demand thing. When there is more demand than items, they can raise the price for anything. I can show you that in July, I bought these KN95 masks on Amazon. I paid like $9 for a pack of 50 of them. Amazon also sent the Tanzania School Foundation like 1,200 surgical masks and some other sanitizing pills and this kind of stuff. And we shipped it all to Tanzania for them to use there. And they were giving it away because, everyone thought that this thing was over, and it wasn't. Today, I get a notification in Amazon, would you like to rebuy these? And now the price is $40 for those same 50 KN95 masks. So I do believe it's a supply and demand thing. The price went up, the price came down. Now everybody wants them again, and the price is going up. And you find this with a lot of other things, right? And the world shut down and everyone ran to tech stocks, and then the world opened up, and then it was everybody ran to travel and leisure, and then the world shut down again, or new variants came out and everyone goes rushing back to tech stocks. Well, now people are rushing to value stocks and not so much the speculative asset. It's going to be interesting to see what happens. We're going to see which companies can withstand the tide going out. There's going to be less money in the system. There's going to be less spending. There's less mortgages being issued. There's less refinances. People who wanted to do that already did that. They took their equity. Interest rates have been low for a really long time. They can't get much lower than what they are. And once interest rates start raising, people are going to want to go into a safer, more stable investment. So I think we're going to see a lot of things moving around in the next year based on what the Fed is going to do. Jerome Powell gets sworn in tomorrow. We're going to hear some words from him, and it will be interesting. On Wednesday, the inflation rate comes out, and it'll be interesting. They're anticipating over 7%. I personally still think it's a supply and demand thing. It's just not ending fast enough, so it looks like it's here to stay. But with the price of shipping still the way it is, and China not sending semiconductors over and hoarding some products on their own end, I think that it is a man-made inflation, so to speak. Also, people aren't spending money on experiences and social activities, and they're not going to restaurants and hotels like they did before. I mean, sure, there was a time where they did, but now it seems to have subsided again, and they are buying goods instead of spending money in the dead of winter doing I don't know what. But anyway, that's what's happening in our economy. There's going to be winners and losers, and it'll be interesting to see. And we can't necessarily blame the Fed for what's happening, and we can't blame the pandemic for the closures of a lot of other businesses. The only thing we can blame is the balance sheets of many of these companies. I will give Hertz, for example, right? Hertz was a company that was around for 102 years. During the pandemic, it wasn't the shutdown of the economy and the travel industry that did Hertz in. What did Hertz in was the balance sheet and the executives in charge of it. They had $18.7 billion in debt and only $1 billion in cash. Well, their debt exceeded their cash and they weren't flush. People will start investing in companies that can withstand the outgoing tide. And those will be their stable investments. They will get a certain return on their money, and it will satisfy them, right? There's a certain rate that people want for their money. During speculative times, they go into more speculative assets. If the interest rates rise, they will go more into a safer asset. And I think that's what people are trying to figure out now. Anyway, those are just my thoughts. Thank you so much for watching. Give this video a thumbs up, subscribe to my channel, and we'll talk again real soon. I look forward to hearing your comments. Call someone, tell them you love them, be kind, and we'll chat again real soon. Have a great night.